Welcome to the inaugural broadcast of Macrobusiness TV. I'm your host, David Llewellyn Smith, otherwise known as Houses and Holes, and today we're joined by Professor Ross Garnaut to discuss a recent trip in China. Professor Garnaut is Professor of Economics at Melbourne University, as well as former Senior Economic Advisor to the Hawke Government and former Ambassador to China. I'd like to begin, Professor, by asking you what your on-the-ground impressions were of the Chinese economy.
Well, things are a bit soft at the moment, and there's a fair bit of pessimism, even a little bit of anxiety around. But China's like that. Moods are mercurial. At the moment, it's a bit downbeat.
Well, we are seeing some of that in some of the economic indicators in the PMI and what have you. That's disappointed markets. But at the same time, there is still quite high levels of credit growth. How do you reconcile those two seemingly contradictory signals?
There does seem to be some divergence between the money numbers and the expenditure numbers. That does reflect some weakness, especially on the investment side for the time being. I don't think things are quite as bad as the mood. Certainly amongst foreign analysts of the Chinese economy, but a lot of Chinese themselves, there's a feeling that things can go down a bit from here. I'm not expecting a big dip.
So the present levels of forecast growth around 8% or just under, are you comfortable with that?
I think 7.5 is the latest official number. Might be a bit softer than that this year. But if it's much softer than that, the authorities will be concerned about it. They'd like to keep it up around or above 7, so we might get some policy support if it looks like ducking into a number with 6 in front of it.
So you're gesturing there at more stimulus, clearly. Is that likely to be concentrated in similar areas to the past with a focus on infrastructure?
No, there probably will be something of a stimulus fiscal package later in the year, maybe not much later, whether or not it's called that. But it's likely to be concentrated almost entirely on energy saving and what the Chinese call investment in the low carbon economy. So it's very different from the boost to infrastructure that drove the big packages after the global financial crisis and after the Asian financial crisis.
So in that case, you clearly don't see even attempts to keep Chinese growth at robust levels benefiting commodity prices?
Increased activity gives some boost to demand for commodities, but it won't be demand at the energy and metals intensive end of things. So it won't change the general story that comes out of recent structural change in China, which is that per unit of GDP growth, there's much less energy and metals in it than there used to be.
So the story you touch on there, which is gaining credence in markets and has done so for the last 6 months or so, is of course Chinese rebalancing. Did your trip offer any further insight into how authorities are viewing that rebalancing project from investment towards consumption-led growth and what we might expect on that front in the next year or so?
Well, a number of different rebalancings going on, David, and some of these are well underway. The biggest rebalancing is away from reliance on growth in export demand and away from net exports. The current account surplus was just about 11% of GDP in the year before the financial crisis, 2007. That's way back below 3 now. Now it's in the range of large economies, below that of Germany and Japan. So you can say that bit of rebalancing is substantially done. Another bit of the rebalancing that's very important in policy is towards growth in rural incomes and away from the coastal areas. That's been the focus of gradually increased government expenditure, especially on rural services like health and education. But there's also the gradual introduction of an income safety net in rural areas. That will all come out as increased expenditure on services. More generally, there's a concern to increase the services role in the economy, which has been very much lower than other economies with similar income levels to China today. That rebalancing is just starting. And then there's a rebalancing to which you referred between investment and consumption. This is being driven by two things. One, the big increase in real wages, which has been progressing now for a number of years, which is gradually reducing the wages, the profit share of GDP, and with it investment. That will grind on steadily a bit more each year for quite a while. And alongside that, there's a deliberate de-emphasis of investment in policy, both government spending and money pushed out through the banks. Finally, there's a rebalancing away from industries that have big negative effects on environmental amenity. This has international and domestic dimensions. China's dead serious about making its contribution to the global greenhouse gas emissions mitigation effort, and they're making good progress on that, and that runs parallel with the concern to reduce local environmental impacts. Likely rebalancing from investment to consumption. This one has a lot of momentum, but it's in its early stages.
So do each one of those four or five rebalancings have particular implications for the Australian economy, or is there one specific standout implication?
Well, all of them have the effect of reducing the energy and metals intensity of growth. The biggest contributor to that is the shift away from investment, because investment uses a lot more metals and energy than consumption, especially consumption of services. The environmental rebalancing, the concern for environmental amenity, both international and domestic, is particularly an issue for the Australian energy industries. It's a negative issue for thermal coal. In itself, it's a positive issue for natural gas because gas is favoured over coal as a low emissions source of energy.
You mentioned thermal coal, and it's trading at some of its lowest levels for many years. At the sort of mid $80 range. Can you see the price of thermal coal going lower still?
I wasn't particularly focused on immediate price effects, but certainly the effect of all of the change that's going on in China, the structural change, is to quite radically change the trajectory of growth in demand for thermal coal from double-digit growth for quite a number of years to probably little growth at all from now on. Alongside that, there will be questions about what happens to Chinese supply. Of course, import demand is affected by Chinese production as well as Chinese consumption. That's harder to assess. But if you don't get quite a substantial pullback in the trajectory of Chinese production of thermal coal, then you could have China emerge not as a large and rapidly growing importer of coal, but one day as an exporter.
So clearly you see China shifting away from high carbon energy intensive growth and bulk commodities in general. So what implications do you see there for the Australian economy?
Well, the flywheels of the Australian resources boom over the last dozen years have been investment and exports in iron ore, coking coal, thermal coal, and investment in LNG in more recent years. The first three of these are going to be experiencing substantially lower prices than we grew accustomed to, substantially lower prices in the end than we used to justify big expansions of supply capacity in Australia and around the world. So we're going to have an overhang of capacity which will lead to the shakeout of high-cost capacity, both old and new. The price will have to be low enough to shake out the surplus capacity. So we could see substantially lower prices while that's happening. That directly affects the Australian economy, directly affects average incomes, especially through what it does to state and federal government revenue. It also affects investment. There's no reason to think now that we're facing the end of this energy and metals intensive phase of Chinese growth that we'll see the share of resources in the Australian economy, resource investment, any higher than historical averages. So that all adds up to a very big downward adjustment. On LNG's more complex, we might come back to that. But that adjustment is going to require a very big expansion of investment and exports in the non-resources tradable industries, services, high-value manufacturers, parts of the agricultural sector, including agricultural processing. To get that, we're going to need a big improvement in competitiveness. We're going to need and will get a big reduction in the real exchange rate. If we're smart, we'll support that with productivity-raising reform. But it all adds up to a very big adjustment, a very big challenge. Unless we make the adjustments early and vigorously, we could go through a very rough patch.
So, in terms of the key being an increase in our competitiveness, how low do you think the dollar needs to go to really start delivering those benefits?
Well, the other industries that we're going to have to get the growth from are in many ways competing with other developed countries, with Japan, Korea, North America, Europe, and here I'm talking about the big service export industries like education, tourism, business services, temperate agricultural products, including in processed form, the specialised manufacturers that come from developed countries. And so we'll have to get our real exchange rate much closer to historical levels against other developed countries, and that's a big change. Markets have their own logic, and they find things out for us as they make their adjustments. So you can never prejudge them, but I'm not going to be surprised by a real exchange rate adjustment in the range of 20 to 40% over the next few years.
And you mentioned as well specifically LNG, which has something of a built-in volumes ramp up ahead following the big investments. Over the weekend as well, the US Department of Energy gave approval to a new proposal from Freeport LNG to export substantial quantities to non-FTA countries in North Asia. So how much support do you expect that LNG ramp up to provide the Australian economy, and what benefit is that LNG boom?
Well, China uses much less LNG as a proportion of its total energy than other major countries, and it's keen to get rapid growth in it, amongst other things because it's got lower environmental impact, both greenhouse gas emissions and carbon particulate emissions. So we'll see very strong growth in Chinese demand. The question is how much of that will be supplied from Australia, and there's a lot of competition. China itself is setting out to make the most of the unconventional gas technologies, coal seam gas and shale gas. It's a late starter in those areas, but it's putting a lot of effort into it, and it could have the geological, or does have the geological conditions that are prospective, but prospectivity isn't potential production, isn't reserves until you've drilled a lot of holes, and they're getting on with that. We may see substantial supplies coming from within China after a few years. The capacity to bring gas overland by pipeline is rapidly being expanded. Pipelines to Central Asia, and recent discussions at presidential level of a pipeline between Russia and China. That's potentially very important. We've accounted for a lot of the seaborne, the LNG trade for a while. The emergence of North America as a competitor is a significant development. North America has adopted more or less the opposite policy to us on gas. We've had an even bigger proportionate increase in gas reserves than the United States. In Australia, the increase in reserves has led to a big increase in domestic prices as exports have grown. In the United States, it led to a very big reduction in domestic prices, and so got a circumstance where domestic gas prices in the United States are a fraction, a small fraction of Australian export prices, with Asian import prices between the two, but up closer to what will be the Australian price. That's not all sustainable. You don't get in this globalized world such very big differentials in price lasting for very long. We're going to see some exports from the United States soon. No doubt the US would prefer to keep its gas prices well below the rest of the world, so there'll be a break on exports, but there are limits to how much the US can control that, because once gas is in a pipeline, it can end up in Canada or Mexico, and so you'll get LNG capacity in those places, even if the US is blocking it. So we've got to expect that over time we'll see a lot more North American gas coming into East Asia. Eventually you'll have American prices going up, East Asian and Australian prices coming down, and the gap between Australian and North American greatly reduced. So the question is going to be, how competitive are we in that new environment? Today's real exchange rate, we're not very competitive at all. We might be getting new projects, and it might be quite a while before there are decisions on any new capacity in Australia.
Some of the big projects that are already underway, Wheatstone for one, for example, are actually quite, or they're at the more expensive end of the cost curve for LNG. Do you think that the steady shift of or balancing towards an equilibrium price, if you like, is likely to prove disruptive for current projects at all, or do you think they're secure?
That depends on their pricing arrangements, and I'm not privy to the detail of that. Not many people outside the company is concerned are. To the extent that they are based on proportions of the oil price, there may be some protection. Although changes in the global energy supply and demand situation will also have downward effects on global oil prices, but the exposure of established Australian projects won't be as large and direct to international gas prices as they would otherwise have been.
So you think that the oil-linked contracts that underpin most of these projects will hold in the new environment?
No, I don't think it will hold completely. One would expect some downward pressure, but proportionately, I would expect less downward pressure on the East Asian oil price than the East Asian gas prices.
All right. Well, thank you very much for joining us this morning, Professor Garnaut.
A pleasure to be with Macrobusiness's inaugural TV video.
Thanks very much.
Bye.